Hello, everyone. I'm Wes Galladay from Baird. Welcome to the Seritage Growth Properties presentation featuring Andrea Olshan, Chief Executive Officer and President of the company, and Amanda Lombard, Chief Financial Officer. I will start the discussion today, but feel free to use the chat box below to participate. I want to begin, though, with first asking Andrea, what is the opportunity set for investors of the company?
Thank you so much, Wes, and bear with me. I have no voice. So, listen, I was on the other side of this company during the interview process, trying to understand the value and understand what Seritage was and what their value creation methodology was, and it was very difficult. And I think that the lessons that taught me about really trying to express the value, because once I came in and I saw the incredible opportunities in making these former Sears boxes into whether it's life sciences or grocery anchored strips or the triple net opportunities. As you may know, our average site is 13 acres. And so we have already 50 triple net opportunities right, that are happening or already executed, and probably the same amount in the pipeline. So when you think about things like that, you start to understand the value. And so the first thing I did is I went through the portfolio with the team, asset by asset, and we looked at the market, we looked at the leasing, we looked at the opportunity really, truly with fresh eyes. And what that did is it sort of laid out that there were sort of 6 main business plans, if you will, for the portfolio. One is multi-tenant retail, right? That's obvious. A lot of those are a factor of Sears downsized before they vacated in a lot of really prime retail locations, and we leased around them. So it's really a play of leasing up the rest of that box once Sears vacated. But the fact that Sears downsized in those locations and didn't reject those leases demonstrates the value of the retail location. Now, when we looked at those locations, as I said, we have 13 acres. We also said, okay, how can we densify? Right? What is, if you have 13 acres of land, on average, often much more, Sears tends to be, by the way, in the best position in the mall because of the auto center, and they wanted that exposure on the main roads. So we often have the best position. So we looked at, can we densify in terms of the auto center? Can we add triple net parcels? Is there a residential or office build-to-suit opportunity? So looking at that, and then this sort of the second bucket was grocery, because as you know, there's a tremendous demand for grocery anchored strips, and a lot of our locations really are incredibly well located in terms of demographics, and they command that sort of tenants. So there is multi-tenant retail, grocery anchored strips, the triple net portfolio, which I talked about. Then separately, there are office and life sciences opportunities. There are places like, Southern San Francisco or UTC, La Jolla, phenomenal life sciences opportunities there. And there are also, Redmond is a market that has a lot of office. And we looked at it both, for office and residential. And that's a bigger site that has probably a lot of densification opportunities. And then we said, what do we no longer want to own, right? So we have all these incredible investment opportunities. Where should we be putting our capital? What's the best use of our capital? And there were some more marginal locations, and we wanted to be proactive about dispositions. I think historically it's been very confusing to the market. Personally, as someone who was trying to understand the company from the outside, quite recently, I didn't really understand the disposition strategy, and I don't really think there was one. I think it was more liquidity driven. And I think that, as you can sort of hear from how I do everything, I'm incredibly methodical, I'm analytical. And so, I wanted to make sure that we are focusing our teams on execution, inclusive of selling the things that we don't think are worth owning in our portfolio. That doesn't mean they're not valuable. They just don't fit in these 6 buckets, which we think are the ways to create value. The other thing is, as you will know, that these 6 buckets translate directly into how you can capitalize this real estate. So, as everyone knows, here, the private markets have been incredibly flush with capital in the last few years, and they need to put this money out. Debt is incredibly cheap. However, the sources of debt and equity in the private markets are incredibly narrow, and they have very, very, very tight mandates as to what they should be or can be investing in with their institutional backers. So what we wanted to do is we wanted to just be a very obvious fit, right? We don't want to be in anyone's, too difficult pile. We wanted, easy to understand portfolios that we can really take advantage of the discrepancy between where the portfolio should be financed from a cost of capital perspective and where the enterprise is being financed as a cost of capital perspective. We have a terrific loan with Berkshire Hathaway in the sense that they've been unbelievable partners with us, super supportive of our sales program, totally get the value creation opportunity, and really believe in the leadership of the company. Personal relationships up and down the line, whether, I've spent time with Warren or Charlie or Ajit, they've all been fantastic and all the way down the line. That being said, it's very expensive money. And, that isn't lost on us. Our preferreds are 7% as well. So, and for debt for multifamily, it's sometimes is right now sub 4s. Premier retail is going off in the 3.5 range. So even if your bogey is called 4%, 300 bips of value there in terms of lowering your cost of capital is massive. And I think people, talk a lot and ask us a lot about the cost of capital. And I think that if anything, they should be seeing it as an opportunity. The other thing I do want to touch on, because it was so interesting to me, not obvious coming in, is I talked about the debt just now and the cost of capital, but also talking about the equity and the opportunities for raising equity. A lot of people have ideas in the market. We actually have the properties to execute them on. So, build for rent, single family homes for rent. People are raising a ton of money around this strategy, and then they have to go look for deals. Well, we're sitting on 20 deals that we could execute today and probably have another pipeline of 20 to 30 behind that. That's unique. It just is, right? Very few people have those sort of opportunities to put out money today. So from an equity perspective, it's really interesting. We are from a G&A and just sort of general expense perspective. I think we're doing a really good job of streamlining that. As you know, we've shut down our ancillary offices, and we've streamlined our operating team, and we're absolutely hiring in the disciplines that we need, leasing, capital markets, things like that. But when it comes to our cost structure, obviously trying to be more efficient with that. But in terms of cash flow, I feel like there's a very clear path to being, cash flow positive, except that we're using all cash for our investments. And I think that's really what that's not how real estate is done, right? It just isn't done. So the most important thing from my perspective is, how do you utilize the value of the land to have imputed equity in deals, right? And you don't have to come up with cash. But there's so much debt and so much equity available on the institutional side for these deals that we're finding we can maintain the large majority of the ownership of these deals just based on the markup of the land value and the amount of debt and equity that we're able to raise around the execution, which is really exciting. So we don't get diluted out, right? Because what you don't want to do is have great ideas but then get diluted out of realizing the benefits of them. So I think from that perspective, there's a tremendous opportunity, and we're seeing ways to leverage our capital and take advantage of the market today.
Great, thank you for that. Maybe we could just stick with, talking about funding the business. Maybe begin with talking about how you view leverage. Traditional debt to EBITDA metric that we all focus on doesn't seem all that relevant at the moment for a company that is so many developments, so much work in process. So how do you view leverage?
No, it's a great question. Listen, we're all NAV all day long, right? I mean, if you're looking for cash flow today, like we're not your girls. Like this is not where you should be investing. But we do have tremendous opportunities, and I think it's really about a loan to value. And if you think about Berkshire's been fantastic, and I think there's lots of opportunities, and the debt is 2 years away, and I think we're gonna have a lot of opportunities. I don't worry about a refinance, but if you said to me, okay, gun to your head, like, what are some of the ways you could refinance and lower your cost of capital? I think it's at the property level all day long, to be honest, because there's just the cost of capital is so low for the product types that we've identified, and the markets are so flush with money. And so when I think about that, I think about a low LTV today on book value, right? That has zero consideration. Like if you're in the 50s on LTV of book value today, without any consideration for the value creation, which is massive. And by the way, it's not theoretical, right? Like we're in for permits, we have entitlements ready to go. I mean, Aventura, that market could not be hotter. Boca is an amazing opportunity for us. Dallas, you think about what we're doing in Dallas and the housing. I mean, Florida is such a big winner. We have so much in Florida. Texas is a massive winner. We have so much in Texas. Life sciences is white hot. And we have between UTC and Southern San Francisco and San Bruno. And by the way, that's just the beginning. That's just the most obvious ones, right? Those are like the most massive, most obvious ones. So it's really exciting for us to think about like the opportunity to use debt creatively to really leverage the value of our land and own a very big piece of really exciting, massive, incredibly valuable developments.
How should we think about the pace of spend for development over the next few years?
It's a difficult. The way that the company was founded was, there was, give or take on a gross basis, $210 million of Sears revenue just flowing in right when the company was founded. And that gave people the time and really the luxury of time of, making plans, thinking about it. And then when they had a plan that they thought was good and shovel ready, they would terminate Sears and start with a plan. Well, that spigot didn't come to a trickle. I mean, it trickled a little bit when Sears downsized, but then it came to a screeching halt. And so we do have a situation other than the multi-tenant retail, which really is about backfilling, the Sears downsize boxes more or less, or they're just, really good retail locations, and we've terminated the lease and we chopped it up into other retail tenants. It really is, everything starts at once. We have a little bit of, it would be nice if we could stage it better in terms of having, some cash flow and then waiting and having other projects. That said, I think if you look at the short term, obviously grocery anchor triple net and the multi-tenant retail are probably in the next, 6, 12, 18 months. And you see there's a lot of SNO income that is coming online, and I think that's pretty exciting. It's really about just delivery, because when you're splitting boxes, obviously there was a construction delay, right? The world shut down. So I think there's that's really in sort of the near term. Then in the middle term, I mean, we do have some multifamily being delivered. I think the multifamily piece is sort of the next thing to hit. It's quick to build. It's just a matter of getting through entitlements. And in fairness, there were some plans where even sometimes you have to slow down to speed up, and even delaying and changing the site plan, the execution, even on a time affected basis, is so much more profitable. And we're able to create so much more value that there are some where we are in for some site plan modifications now, which we actually think are net extremely accretive. And then I would say the longest are, things like the life sciences, right? So you look at something like UTC, the density there is massive, right? Dallas, similar. Also, we're not doing spec office. There were a lot of plans with spec office. I don't think that's the business we should be in. I don't think that's the business our investors want us to be in. I think that especially suburban spec office, you look at a market like UTC. UTC is a super prime class A office / life science, market. And I think you can go either way there. And we are looking at it again, no pride of authorship, totally agnostic. It's all value creation, return driven, what we're going to build there. But what I would say is, we've taken a lot of the spec office out of the plan. And I think as the demand for multifamily is so exciting. We've really tried to densify further in multifamily and really create more efficient buildings where, if you're going to build it, don't build it in a phase 2, right? Like build a really efficient community. Dallas is a great example of that. We think there's an opportunity in Dallas to build, 500 more units easily above and beyond the original plan. Plus grocery, plus out parcels. I mean, it's a really, looking at sites like that where you could really densify into, if you will, the darlings of real estate today, in terms of, what's attracting financing, both on the equity and debt sides.
Great. I do want to hit on the operations and tenant demand in a second, but we do have a few relevant to this topic questions from the audience. Let's begin with the first one here. Do you have a timetable on when you'll be, completing the projects at Redmond, Valley View, and Hicksville? Probably a little bit of a range here, but I don't know where you're at on your plans there.
Yeah, so I would say, Redmond, that is a plan that we have tweaked. We think that there's, a tremendous residential opportunity there, above and beyond the residential that's been slated. So we're working with the city right now to see how we could potentially densify that with residential. We think that's really the right play there. I think the timeline is similar because the entitlements are similar. I just think the end product is going to be different. In terms of Hicksville, I think there's, we have one of the best grocers in the world you can imagine coming into Hicksville, as well as a tremendous opportunity to add a lot of out parcels. We have modified our residential plan. I mean, listen, the market talks to you and tells you what you need to build, but also municipalities. And when they tell you what they're going to let you do, you have to listen. We did get caught from a timing perspective in the sense that while we were trying to get our plan entitled, the town actually entitled themselves 1,000 units by the train station, which really checked the box for them on their transit-oriented developments. And so there really is no appetite for a multifamily product in Hicksville per the town. And I think that there are other plans that we can execute, which we will go public with shortly, that I think are incredibly valuable. From our calculations, we're actually more profitable than the original plan and can be executed more quickly. So I think that's really the key is looking at something like Dallas is very similar. We have a grocer that we're looking to build with residential on top. We have a site plan with the city. We're looking for some modifications, like I said, because we think there are some sites that were office. And that I think we can, obviously do a build-to-suit office, and we are talking to some, super high credit tech tenants about doing some build-to-suit space there. But there's also a densification of the residential, and that's the play we're focused on now. Listen, in certain cases, you have something like Valley View Mall. I don't own it, right? I don't have control over it. I think the market's fantastic, but we have to look at our sites as really self-sustaining. And they're big enough. I mean, Dallas is big enough that, this could be its own master plan development and will be its own master plan development without the mall. They figure it out. Terrific. That's great. It only helps our value, and eventually they will. But what I'm not going to do is sit and wait and not control my own destiny in, a piece of land that is as valuable and well located and as robust of a market as Dallas.
Got it. And one more from the audience. Question is regarding the disposition program. Will it be more aggressive than the prior the management team had going? And then will the overall realization of value between construction spend be a little bit slower than previously?
Okay, so dispositions, it's gonna look like we're selling more stuff because this is it. So before, we would just sell things like one off, as opposed to looking at the whole portfolio and saying, okay, this is the stuff that we don't want to own, right? This is the stuff where we don't add unique value to owning this, right? Or it's just not our best use of our capital. We're not going to execute the best on this. We rather double down on our best projects. So, like that it's going to look like a lot, but this is it. This is what I'm selling. And then like, it's just the stuff I don't want to own. So we're just more intentional, I would say, about it. And then in terms of, sorry, the follow-up question was the second question.
The realization of value will just take a little bit longer than previously anticipated. I think you may have already touched upon it a
In
little
some
bit.
cases, yes. In some cases, absolutely not. I mean, that's the thing, is there are a lot of places where the plans that we were trying to entitle were just not what the realistic in terms of the city. And you really have to weigh, I mean, time is money. Obviously everyone knows that. And getting entitlements are not free. So, there's a lot of money being spent in consultants, and by the way, our own time, right? Like there's a lot of, this team needs to execute. There's a laser like focus on execution. We have split the whole company. Not only have we split the portfolio into 6 sub portfolios based on execution, we've actually split the company into interdisciplinary teams to execute. So they know that if there's a plan that has a low probability of execution, move on. Let's make sure there's something just as profitable that's more realistic. It's actually going to be better for the company and shareholders. Most important.
Now maybe we can look at the demand. You obviously scrubbed the S&O the S&Os, got rid of some leases that were probably not the best for you. And I guess what retailers are you now focused on, and where are you seeing the highest demand?
Yeah, so listen, I think COVID has taught us a lot, and I think our centers are the big winners coming out of COVID. Listen, I think our collections demonstrate that, right? Like we have 100% compliance with every rent deferral program that we put together, right? So all of our tenants paid for their rent deferrals. We have 97% collections rates. Our rates were in the 90s all the way through the pandemic. So, buy in store, buy online, pick up in store, curbside pickup, the opportunity for outdoor dining, right? So I think we are the big winners. Value obviously was a huge winner. So if you look at our tenancy, the value players are a big portion of our tenancy. People like Dick's Sporting Goods. I think people being outside, exercising in their homes, playing sports, and sports have all returned with incredible enthusiasm. I think they've been the big winners of COVID. And grocery is an obvious one. The grocers know, based on the ordering online and so much shipping, grocers know where they have holes in the market, and they know where the demand is. And so there's such a transparency from the retail side, because there was so much online shopping and there was so much shipping, that you take someone like a Whole Foods or a Walmart. Amazon knows where they're sending all this stuff, right? They knew where the density was, so now they want to place grocers where they know they were shipping stuff, right? Walmart is the same, Target, all of these companies. So that part of it's been really interesting. The other part are the triple net out parcels, right? So we have, not only do they offer an opportunity for outdoor dining, but curbside pickup and drive-throughs, right? Drive-throughs were the massive winner. And it used to be a nice to have, now it's a have to have. And it's very hard to accommodate, right? I mean, you need a lot of space in terms of queuing and traffic and everything else, which right now we uniquely can accommodate. When you look at, the mall or other boxes that are vacant, and you look at their parking lots, and ours looks like a fan, right? It's like this, it's this box in this massive lot. And then you look at everyone else's, and it's like this, and they just can't accommodate it. We're so overparked. We have so much space. So it's really exciting. Those are great opportunities. The other thing I would say is people have asked us a lot about last mile and logistics. One of the best parts about being well located is it's usually not your highest and best use to just have like a bunch of trucks and loading docks. We have about 3 locations where we think that industrial or logistics is the highest and best use, and those are terrific markets. One of them is in, South Florida, where the rents for industrial are super high. Obviously, cap rates are super tight, and there's so much money flowing into it. But separate and apart, from a last mile perspective, really what the pandemic did was the store became last mile. And retailers realized that when they couldn't open new locations, they couldn't, it's not like you could just put up some industrial logistics center or last mile distribution center in 2 seconds, especially when the whole world was shut down. They got super creative about using their stores. And between the data that they have from online shopping and the repurposing of their stores and using merchandise within stores and between stores to fulfill last mile, and all the, really the online purchases and curbside pickups, they're looking at stores totally differently. And we're seeing tremendous demand for leasing now. And tenants are really focused. They're super focused, and they want a deal because they know that, they want to be in that location, and they're very specific, and they want to close. And we're happy to be the recipients of that.
Can you clarify? I believe all your centers are open air or have open air access. So can you clarify that point? And then maybe you can talk about pricing power. Who has the negotiating power between you and the landlord right now? Or you and the retailer? Sorry, you are the landlord. Yeah.
So we have 0 enclosed malls. We are attached to, but we don't have any indoor space, which has been a tremendous winner. And there are a lot of people that actually are popping out of the mall that are interested in our location. So that's really exciting. In terms of who has the balance of power, like I said, I think that they're not the value players that are very well suited for our portfolio are expanding. And they're, like I said, they're very specific on the locations, and they want to make deals, and they want to show that they're growing, and they want to grow in the markets that they care about. I think the best part of our multi-tenant portfolio is we really don't have any small shops. So the small shops that we have really are out parcels, which then fall into the triple net bucket, which, credit, super tight cap rates, tons of demand for them. And we have a really robust portfolio of them. So I think by not having the small shops, that's where there's not as much leasing velocity, because of so many, unfortunately, small businesses were so destroyed by COVID. So I think really the balance of power even from pre-pandemic to now, I think is more equalized, which is really exciting. I think people also want to take advantage of the stimulus money and people's, demand to get out there and shop and eat and do all these things again. And so from an execution perspective, the timelines are definitely shorter than they had been. There's not sort of the, window shopping that there was, I would say, 2 years ago.
Got it. Well, I am seeing no further questions from the audience. So, I think I can turn it over to you if you have any closing remarks, or we can end it here.
No, listen. I think that looking at this company as all the portfolios that we have, and the value of those sub portfolios, and also the portfolio premium on those types of properties, I think is really the way to look at it. And like I said, it's a NAV story all day long. It's a value creation story all day long. And listen, I don't think, having come from the other side of being an outsider looking in, trying to understand the value, we have not historically done a good job of demystifying a complicated company for the investors. And I just, as you can see from the deck we put out, from, this sort of, these interviews and discussions, we are looking to undo that and to demystify the company, because I think it's really in understanding the component parts that you understand the value.
Well, Andrea and Amanda, thank you both. I look forward to seeing you later.
Thanks.
Thank you.